Watch this data line. You see resistance break. You buy the momentum, and seconds later, the bottom falls out. You fell into a liquidity sweep. Institutions engineer these exact moves intentionally to hunt for orders. Over the next 5 minutes, we are going to build a mechanical setup to trade the London Open reversal, step by step. Because if you do not understand how smart money operates, your stop loss ends up paying for their entries. Step 1 is defining our starting environment. The Asian trading session is usually quiet. Volatility drops, price drifts sideways, and retail traders start drawing their baseline support and resistance levels. On this sideways chart, we map boundaries by drawing a box around the highest high and lowest low of the session. Traders buy the bottom, placing stops below, and sell the top, placing stops above. This creates massive concentrated pools of trapped orders. When massive London session volume hits, banks and hedge funds need counterparties for their heavy positions. They must hunt exactly where that liquidity lives. That Asian range box serves a specific purpose. It maps exactly where institutional money is about to attack. Now London opens. The first thing you will often see is an aggressive, heavy green candle exploding through the top of your Asian range. This is where you sit on your hands. Retail traders are flooding in, terrified of missing the breakout. Let them. Look closely at how this candle closes. If hunting liquidity, that aggressive green push will suddenly stall, reject the high, and collapse back inside our box. This collapse needs displacement. Watch for heavy, fast selling pressure moving exactly opposite to the initial breakout. Look at the long wick left behind at the top of that failed move. We call that the sweep wick. It is physical evidence that institutions triggered retail stops, absorbed the liquidity, and walked away. If price breaks out and just chops around the highs, we do nothing. The setup demands a violent rejection and immediate displacement, or you abandon the trade. True market direction reveals itself through that specific rejection sequence. The trap determines the trend. Once we confirm the trap, we scale down our chart from a macro view to a 1-minute or 5-minute time frame to execute surgically. Heavy displacement leaves a fair value gap between the first and third candles. Set a limit order at the gap's edge, letting price pull back to fill. Place the stop exactly above the sweep wick, targeting the bottom boundary for the next liquidity pocket. If price pushes back past your sweep wick, the thesis is broken. Take the loss immediately. Never adjust your stop. You also need a time constraint. If this exact setup fails to materialize within the first 90 minutes of the London session, close the charts. The opening window provides the highest volume and the cleanest structural moves. Outside of that window, you are trading messy, low-probability volatility. Professional scalpers rely entirely on precise structural entries and completely rigid risk parameters to build their edge. Watch this final execution. Price retraces, triggers the limit order in the gap, and cascades downward cleanly into the profit zone. You just secured a highly calculated short position off the exact same move that wiped out the retail breakout buyers. Before you risk live capital, load up your history. Scroll back and map out 20 examples of this exact mechanical sequence. The market rewards patience over prediction. Wait for the structure to form, validate the confirmation, and stop